Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DeFi Development Core.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. This one is really interesting because the whole story, the whole thesis, it really rests on one single very bold decision.
Right. This is the first U.S. public company to, build its entire treasury strategy around Solana?
Exactly. Not just buying it, but actively accumulating and compounding it. It's a completely different approach from, just sticking some Bitcoin on the balance sheet.
So people talk about this creating a structural moat. What does that actually mean for, say, a public markets investor who wants exposure here?
It means you're not just buying the token, you're buying into the entire operation. They hold SOL, sure, but the critical part is that they run their own validator infrastructure.
Ah, so they're part of the plumbing. They're helping to run the network itself.
Precisely. They're not passive. And that gives them a kind of access and an operational yield that you just can't get from a simple trust or an ETF. It's active management.
Okay, so that's the crypto side. But what stops this from just being a pure play crypto fund? There's another piece to this, right?
There is, and it often gets overlooked. It's the legacy anchor.
Real estate business.
Yeah, the commercial real estate data and software platform. And it's not a small thing. We're talking over 1 million web users a year.
Wow.
Thousands of lenders. More than 10% of U.S. banks are using this platform.
So what's the point of that? Is it just for credibility, or does it actually, help the bottom line?
It does both. It provides a really stable, predictable stream of fiat revenue. It covers operating costs. And yeah, it gives them that credibility on Wall Street. It shows they're not just a risky crypto venture.
Okay, let's pivot to the financials then, because this is where the story, it gets kind of hard to believe.
It really is. The Q3 2025 disclosures, they lay it all out.
So the operating revenue from that real estate platform was what, $4.6 million?
$4.6 million for the quarter, a respectable, steady business. But then you look at the other line item.
The unrealized gain on digital assets.
$74 million.
$74 million.
In one quarter. And that brings the year-to-date gain to $96 million.
That disparity right there, that's the whole story, isn't it? The crypto appreciation is just completely swallowing the legacy business.
It is. And this leads to some valuation metrics that, frankly, look broken if you're a traditional analyst.
You mean like the PE ratio? I saw it was trading at something like 1.8.
1.84, yeah. Now, a PE that low, under 2, it usually signals one of two things.
Either the business is about to collapse,
or the market just cannot keep up. The earnings power is growing so fast that traditional models and analysts are structurally lagging behind.
So why is there such a lag? Why hasn't the market priced this in?
It's this concept of operating leverage to the Solana ecosystem. Wall Street is used to modeling, subscription revenue. They're not used to modeling these huge, volatile, mark-to-market crypto gains.
So they see that $74 million gain and they think, well, that could be a $74 million loss next quarter.
Exactly. They struggle with the permanence of it. But if you start to value the company based on the amount of SOL it holds per share, the picture changes completely.
Which brings us to how they're making those earnings sustainable. It's not just about price going up.
Right. They are actively compounding. They're not just sitting on their assets.
And the yield they're getting is pretty impressive.
It is. The organic yield from their validator operations and deploying their treasury was 11.4% in Q3.
Just from securing the network.
Just from participating in the network. But that's not even the whole story. They're taking it a step further.
This is the Perena partnership, right? The stablecoin strategy.
Yeah. They're aiming to mint the USD stablecoin to capture a yield they estimate at around 15% APY.
Okay, a 15% yield on a stablecoin? That sounds high. And, high yield usually means high risk in DeFi.
It definitely comes with risk. There's smart contract risk, counterparty risk. But it's what they do with that yield that's so clever.
It's not for paying out big dividends or anything like that.
No. The plan is very specific. The proceeds from both the staking yield and that stablecoin yield are earmarked for 3 things. Cover OPEX, fund share buybacks, and buy more SOL.
Okay, so let's break that down. They create a kind of self-reinforcing loop.
That's the perfect way to put it. The yield they generate pays for them to buy back their own stock.
Which reduces the number of shares out there.
Right, and if the share count goes down, but the amount of SOL they hold stays the same or goes up.
then the amount of SOL per share goes up. The intrinsic value if each share increases.
Precisely. They're using the network's own rewards to systematically compound value for their shareholders, independent of the daily price of SOL.
And they seem to be building out the infrastructure to attract more serious institutional money, too.
Absolutely. The warrant trading started, which is one piece, but the bigger deal is their plan for a Solana-focused preferred stock.
Which would appeal to investors who can't touch common stock or crypto directly.
You got it. Think pension funds, certain endowments. It's a high-yield instrument that gives them regulated exposure to the ecosystem. They're building all the on-ramps.
Now, we have to talk about the chart. I mean, the stock's performance has been astronomical.
It's been parabolic, up over 700% in the last year. And at one point in 2025, it had, I think it was a 24,000% gain year to date.
That's just a crazy number. A run like that, it has to correct. It has to consolidate.
And that's what we're seeing now, a pullback, a consolidation phase. The market is basically taking a breath and trying to figure out what a fair price is after that kind of move.
But during this pullback, we're seeing some really strong signals from inside the company.
We are. And there's no stronger signal than an insider buying with their own money.
The chief operating officer.
Bought over $100,000 worth of stock, about 17,760 shares around the $5.76 level.
And buying after a huge run-up like that.
Yeah.
That's a very powerful statement.
It tells you management believes the intrinsic value, that net asset value driven by their SOL holdings, is still way above the current stock price. It's not a top-is-in signal. It's a reset and reaccumulate signal.
And their communications seem to back that up. They're not hiding.
Not at all. Their November business update was titled, Executing on All Fronts. They're hiring, they're launching new partnerships. It suggests the story is still really underfollowed by Wall Street. There's room for it to run as the big institutions catch on.
Okay, so we've laid out the bull case. Let's flip it. What's the biggest risk here? What's the bear case?
The bear case is, well, it's pretty simple, and it's the elephant in the room. Extreme sensitivity to the price of SOL.
The low PE ratio doesn't protect you if the value of your main asset gets cut in half.
It doesn't, because that PE is based on unrealized gains. A big drawdown in the crypto market would hit their NAV and their reported earnings directly and immediately. You are, at the end of the day, making a highly levered bet on crypto.
And beyond just the market price, there's the operational risk of what they're doing in DeFi.
100%. Running validators, interacting with stablecoin protocols, that all comes with risk. Smart contract bugs, hacks, a stablecoin depegging. These are very real catastrophic risks.
Not to mention regulatory risk, which is always hanging over the space.
Always. A bad ruling on accounting for digital assets or a crackdown on DeFi could really change the game for them.
So what are they doing to, mitigate some of that?
They're focused on non-custodial strategies, which helps, and they're diversifying their capital structure with things like the preferred stock, so they aren't reliant on just one DeFi protocol. It's about being as operationally tight as possible in a risky environment.
So looking ahead, what should people be watching for? What are the near-term catalysts?
Well, the most immediate one is the December 5th X Spaces event. It's an AMA, a chance to hear directly from management about the treasury strategy.
Any news there could move the needle.
For sure. And then further out, we've got the Q4 2025 earnings report, probably late February. That's going to be a huge one.
And this is still a high beta play on the whole macro environment, right?
Absolutely. Any good news on crypto regulation, any sign that interest rates might ease up, that's a massive tailwind for a stock like this.
So to sort of wrap it all up, the thesis is that this company is a levered play on Solana. You get exposure not just from the price, but from staking yields and these higher risk DeFi yields, all feeding back into a buyback program.
That's it. It's designed to drive that net asset value growth way faster than the market currently appreciates, hence the low valuation.
So the crucial question for an investor is whether that unique structure, that compounding loop, is enough to outweigh the sheer undeniable volatility of the crypto market.
That's the multi-million-dollar question. It's a high conviction story, one way or the other.
If you enjoyed this analysis, make sure you hit that subscribe button to keep getting smart wealth delivered daily.